I'm Charlotte McLeod with investingnews.com, and here today with me is Josef Schachter. He is president and author at the Schachter Energy Report and a 40-year veteran of the industry on both the buy and sell side. Thank you so much for being here. Great to have you.
My pleasure. Good to be with you again, Charlotte.
Yeah, it's really good to be catching up with you. I was checking, and our last conversation was all the way back at the very end of 2024. So, of course, a lot has happened since then. I thought we could begin with just a quick recap of the oil market in 2025 so far. Any key takeaways that you would pull out just to get started?
Yeah, I think the big thing is just the big difference in the price of oil. Beginning of the year, $79. Everybody was pretty happy with that. And then you go into April and you're $56 a barrel. And, we're about $62 today. So, at 79, the industry was quite profitable. Companies, and many of them were talking, or many forecasters were talking about 80 or 85 by the end of the year, and demand growth. And then, of course, President Trump said tariffs, and threw everything into a tailspin. And of course, everybody started talking recession, 100% tariffs on China. That doesn't work. 145% tariffs doesn't work. And so we still haven't seen the impact on that in the economy. We saw, a negative PPI number this week. But the key thing is many companies, including Walmart, have said the price increases from the tariffs will start hitting in June, which is a few weeks away. And that's going to cause inflation numbers to go up. And even Jerome Powell from the Fed chairman has now said that the tariffs and all these uncertainties are going to be problematic. You also have a budget crisis in the States. Are they going to have a budget? Are they going to move the debt limit up? Are they going to be able to put through the tax cuts they want? Or are they going to have to, do budget cuts? Again, when you have a $2 trillion deficit going to 3 or 4, it's crazy. You want that number to go down. So, and right now, I think the revenues in the U.S. are $5 trillion, and they're paying $1 trillion in interest payments. Well, if interest rates go up, that's a problem. If the amount of the debt goes up, that's a problem. And the amount of money you have for programs becomes a problem. So that's really kind of a global issue. Going to energy, there's two theses out there. There's one that we might go into recession because of the tariffs, and that means demand for oil goes down. And you've got some doom and gloomers saying we're going below 50. And then you've got people like myself who are on the optimistic camp who say, look, we're going to handle the tariffs, which, because they're not going to be, Trump likes chaos, throws crazy things out, and then he becomes more rational, or he has the Secretary of the Treasury, Besant, be the rational one, and good cop, bad cop. We know which one the bad cop is. And, Besant is trying to get deals that make sense for both parties that they can live with and move forward with. So I'm in the camp that two things. One, I don't think we're going to go into if we have a slowdown, that's one thing, but a full-fledged severe recession like we did in 08, 09, I don't see that. Second, on May 27th, not far away from where we're talking, the U.S. is going to be putting sanctions on Venezuelan crude. So Venezuela will not be able to sell crude into the Indian or Chinese markets or whatever, and they'll lose about 500,000 barrels a day of production. So from 1 million, they'll lose half of it. And there's so many ways they can do sanctions on the buyers. They can use, access to the SWIFT financial system, insurance. There's so many ways they can sanction potential buyers that they're not going to buy. You're already seeing Chinese, teapot refineries saying they're not going to buy anymore. Reliance Group, which is the largest refiner in India, saying they're not going to buy anymore. So that's number one. Number two, the issue with Iran is a big one. If there's an Iran nuclear deal, then the sanctions may come off, and Iran will be able to then get foreign investment to build up their business. I think they produce about 3.3 million barrels a day, so that about half of that is exported. On the other hand, if there is no deal and the U.S. puts on severe sanctions, they could lose 1.5 to 2 million barrels of that production. And if people remember, during Trump's first term, when he put on the sanctions, they lost 2 million barrels. They were about 4 and they went down to 2. So we know that sanctions can work. We know that Trump has done that before. And right now the concern, as we heard from Senator or Secretary of State Marco Rubio, is that the Iranian nuclear program is close to having fissionable material for nuclear weapons, and they're weeks away potentially. So either they stop them and get them to give that away, allow nuclear inspectors to go in, and then they can have a nuclear program for peaceful purposes, nuclear power or whatever in their country. But the nuclear weapon side is not there. If they don't agree to a deal, which right now looks more likely of the two choices, then they will have sanctions on them sometime during Q3. And if they lose 1.5 million, so then you have 500,000 away from Venezuela, 1.5 million off from Iran, plus demand growth. And there's estimates on the bear side, 800,000, on the high side, 1.4 million. Let's make easy for math, 1 million. Then all of a sudden you have a 3 million barrel demand increase. Right now, because we're in the spring shoulder season, supply is a bit above demand. Once you get into the summer, demand will be higher than supply. And definitely in Q4, when you have Iran and Venezuela, sanctioned, then we will have a decline, a very tight inventory situation, demand higher than supply, and inventories today, global inventories, not just U.S. or anywhere you want to talk individual countries, we are at the lowest level that we've been at in a decade in terms of global inventory. So any supply shock, i.e. Iran and Venezuela, is going to drive prices up. I think we'll see $70 before the end of Q3. And in Q4, I think we'll see an 80 handle. So it may not stay there the whole time, but it'll pop up 80, 81, 82, back to 78. But I think we're going to be looking at 80s, and then in 2026, even higher. So my view is, when you get these periods of weakness, and I think we're, if we have weakness in the stock market, oil goes down below 60 again, we're going to get another buying opportunity like we had in early April. If you remember from our research, in early April, we said we have a table pounding buy. We sent out an SCR, Schachter Energy Research Action Buy Alert, and added additional names to the buy list. And we said, these are bargain prices here. Take advantage of it. Many stocks from that level are up 20, 30%. So it was a good investment window. I think we'll pull back a bit. We may not get as cheap prices as we got in April, in the first week in April, but I think we'll get another good buying opportunity sometime during June. And we'll be sending out an action alert to subscribers so that they can take advantage of it and add to their positions depending upon their risk profile. Do they want conservative pipeline infrastructure? Do they want companies that are in the EP sector that have growth plus pay a dividend? Or do they want companies that are just growth? So, and then also the service sector. So there's a lot of opportunity, both domestic and international, as well. So, when I look at the list, our action buy list, I see, a large number of opportunities there. And again, I think we've been cautious in the sense that we said, don't go to a fully invested position yet. We think that the next buy signal, when it comes, we would say to people, depending upon, what you want in energy, be it conservative energy, pipeline infrastructure, royalty trusts, or E&P, that's when we think you might want to go to whatever a full position is for you. And again, sit down with your investment advisor, what is appropriate for your risk profile and your long-term goals, and then pick the names that fit that. And in a lot of cases, you could be ending up with a portfolio of 6-7%. There are a lot of high quality companies out there today that yield over 10%, shockingly 10%. So if you want a mix of a portfolio, you could end up with a 6% yield between companies that don't pay a dividend and those that do. And so that, compare that to what you can get in the bank. At the same time, you're getting stocks that are extremely cheap based on historical measures of price to, to NAV, price to cash flow, all of the metrics that you look at. So, these are bargain times, and every time you get a dip, we're saying take advantage of the word. And instead of using the 4-letter word sell, we're saying the 3-letter word buy.
Okay, that's a really great overview, I think, of what we're seeing in the oil market right now. And so we've got those two scenarios that you laid out, and you're going in the bullish direction. I wondered if there's anything more that you would add on the price. So price is still for you going higher than we are right now, but it sounds like there's going to be quite a bit of volatility. Would you say that's correct? And the other thing I'm wondering, there is still that bearish sentiment in the market among some people. What would be the downside risks, the biggest ones that you're looking in terms of your price targets?
Yeah, the lowest, if you remember, in early April, 56, we bounced to 65. We came back down to 57. We're now 62. The downside is in the 50s because the industry stops drilling and the U.S. production levels will come down. Canada, of course, we have the benefit of a 1.4 currency. So, with a, 71, 72 cent currency. So oil companies do benefit because of the Canadian dollar, the exchange rate benefit. But in the, globally, a lot of companies, when they see, if it's below $60 Brent and mid 50s for WTI, they're going to stop drilling. We've already heard American companies say that they're going to lower their capex. They're not going to drill as much. If they cannot make drill wells that are going to be attractive economics, they're not going to do it unless they have commitments where they went to a landowner and said, we'll drill 2 wells on you during the year. They'll have to drill those wells on a commitment basis, but anything that's discretionary will stop. So the high water mark at the beginning of the year, the U.S. production data, and again, we get this every week from the EIA, the Energy Information Administration of the U.S. government, was 13.6 million barrels a day. That's the high water mark. The last week's data was 13.4. So we're already seeing a bit of a downturn in the U.S. production statistics. And the longer the price of oil stays low 60s to below 60s, we're going to see the U.S. numbers come down. And that is very bullish because, the industry needs $70 probably to justify drilling. And if you want to see a growing American production profile, you're going to need $80 WTI or higher. And we've heard that from a number of CEOs of major U.S. companies saying that if you want us to drill more, drill, baby, drill, it's not going to be at $40 or $50. It's going to be at $80.
Yeah, I think that makes complete sense. And, just looking at some of your comments in your latest Ion Energy report, as we're talking about all this turmoil, you mentioned the potential for a geopolitical black swan that could be quite disruptive for the stock market. So I know black swans, of course, inherently they are unknowable, but I'm wondering if I could get your thoughts on some of the events that you're considering you make that statement.
Yeah, you can look at everything from geopolitical, where something happens, with China and Taiwan, Russia and Ukraine, that war expands. Something happens with Iran where they don't, and they close the Straits of Hormuz. It could be something with the U.S. deficit, or debt. Bond auctions in the States, U.S. 10-year treasuries have gone up, as have 3-month T-bills have gone up here. If all of a sudden auctions to finance the deficit, $2 trillion plus the renewal of bond auctions, if we have a bad auction and all of a sudden people see that the American government needs so much money and we have foreign owners like Japan and China selling U.S. debt and not buying more new debt, all of a sudden you could see a crisis on that side where the U.S. can't finance cheaply, and the cost of getting the bond offers are going to have to go up from, let's say, 4.4, 4.5 on the 10-year. If they go up to 4.8, which was the high, last year, and shockingly, if they got over 5%, that would really scare the markets, and that would be a discount mechanism for what you would pay for stocks. In other words, the multiple you'd pay would go down as interest rates go up. So that's not there. The budget issue right now, if somehow the deficit hawks say no, and there's no deal, then, you don't have Trump's tax cuts kicking in at the end of the year. That would be harmful to the U.S. economy. Small businesses would be hurt because of that. And that would be an issue. And then the other one is the debt limit. It's right now 37 trillion. They're talking raising it by 4 trillion, for 2 years, and then, leaving it to the next Congress to deal with. So there's a lot of wild cards here. And so any one of them could spook the markets, and the markets do not like uncertainty. And so uncertainty causes, the big decline that like we saw in the general stock market, from the 45,000 on the Dow down to, I think, 38,000. So we could see some, pretty nasty markets if one of these black swans, and there's probably others I haven't even thought about, North Korea could do something. There's a lot of crazy places around the world where, the people are not logical, and they could do something that really, puts a problem to the world, and any problem would be disconcerting to stock markets.
I think it's really important to just be aware of that broader context. And I think it's okay also if you can't think of the black swans, because that's the kind of how they work, is they come out of nowhere. So we'll see what happens there. Just when we're on the US and Trump, I wanted to go back. You mentioned drill, baby, drill, and this is what Trump had campaigned on. He also would like to see lower oil prices, which the companies, as you mentioned, they won't drill until there are higher oil prices. So overall, how are you seeing the interactions between Trump and the oil industry developing in his second term in office here?
Well, the Secretary of Energy is from the oil patch. He was the former CEO of Liberty, which is an energy service company, a fracker, and a big one in the U.S. Liberty also operates in Canada. So you've got somebody who knows the industry and knows what can be done and what can't be done. So, Trump wants the United States to be an energy superpower, and it can be. And the big part of it would be, if we do have adequate prices, attractive enough economic prices to bring on more oil, but more importantly, natural gas. The United States went from nothing on LNG a decade ago to about 15.7 BCF a day of export capacity with LNG that they're selling to Korea, to Europe, of course, big need there, because they're not buying Russian gas as much, and to Japan and other India, etc. So they could, based on the projects that are already approved and that are in the pipeline, by 2030, they could be producing 28 BCF. So that's a growth business. And they would be, right now, they are the largest LNG exporter in the world, more than Qatar, more than Australia, and that's from nothing a decade ago. So they will be much, much bigger by the end of this decade with all the projects. And we in Canada will have our first project on June. The first cargoes from LNG Canada will be exported during June, from the data that we're seeing. And then you add in all the other projects that are in the pipeline. By the end of this decade, we could have 5 or 6 BCF of Canadian exports. Putting that in context, domestic production is about 18 or 19. So that's a pretty good growth rate into the end of the decade. And that's why we're seeing the consolidation that we're seeing, where Chevron sold their assets and CNQ bought them. We just saw the announcement where Strathcona is selling assets to ARC and to Tourmaline. And so there's a lot of deal flow going where it's concentrating in a number of hands, which are very big, which can be have the credit worthiness to be involved in the LNG export market, or can tie down pipeline capacity to take natural gas down to the U.S. Gulf Coast and ship LNG from the U.S. Gulf Coast. So ARC, Tourmaline, are the big boys there in that, and the consolidation and deal flow, I think, will continue as the big boys decide they want to control the reserves. And then the LNG operators, the ones who have the LNG plants and have those 20-year commitments when they do deals, they're going to be also wanting to control reserves, and they would also be a buyer. So I believe in the latter part of 25 and probably very active in 26 will be the M&A side. And the deals we just saw this week with, Strathcona and ARC and Tourmaline, will be more of a regular event than just something that happens every few months, when we see a deal announced.
Okay, really interesting. So more M&A to come, and I've got more questions on the companies for you. But before we get into that, I want to look at Canada as well. So you started to mention what's going on in Canada, and I think it's really important to talk about because we've also had a transition in power here. We've got Mark Carney now taking over from Justin Trudeau as Prime Minister. So I'm wondering what you think that the oil industry is going to look like under Carney. People, I think, are wondering, okay, are we going to get similar to Trudeau, or is it going to be different? So what are your thoughts?
Well, that was why the swearing in of the ministers was very important. And I was watching it on TV, and which I normally don't watch politics in Canada, but the impact on the industry was so important that I did. And when you saw the announcement that the new environment and climate minister was a climate activist who is not fans of the fossil fuel industry, that was a negative. And then, the positive was the energy minister was somebody who came, from the private sector, had been an advisor to Carney when he was in charge of the Bank of Canada, but also comes from, I think Goldman Sachs world. So he has experience in our world, the investment world. So I thought, that was a good point. But then Guilbeault, who doesn't like fossil fuels, came on the TV and got interviewed, and he said, we don't need any more pipelines. Peak oil is coming, and we have lots of capacity in our pipelines. We're only using Trans Mountain 40%. And the reality is he didn't even know his own numbers. The numbers are between 70 and 80%. And it's impossible to run pipelines at 100% because there's maintenance time. You've got to clean the insides, so we're really effectively getting close to full capacity on TMX. Might take another year, but, if we get a little more growth in the industry, TMX will be full. The Enbridge lines going south are full. And so the announcement that Strathcona made where they bought the Hardisty terminal for rail cars, which was announced yesterday, tells you that people in the oil sands and the thermal oil SAGD side believe we will be filling the TMX up, within a year or two, and all of a sudden we're going to have to do oil by rail again. And that was why Strathcona, made the decision to, number one, buy the Hardisty, and number two, make the overture to buy MEG and consolidate that to be a much bigger player in the SAGD oil sands business.
Okay, really good to go over that. So if we're in this environment where we have Carney and we have his ministers who maybe are not quite up to speed on what's going on in terms of the energy markets, how are you feeling about the Canadian oil and gas companies in this new scenario?
Well, given that, nobody's going to turn off the pipes down to the States, the Americans aren't going to want it. And, within Canada, the oil and gas will flow. So I think the industry doesn't have a big downside, but it's the growth on the upside and how there's going to be growth, what the carbon taxes are, which affects profitability. Those things, maybe federal taxation changes, which impacts profitability. But the stocks are trading so cheaply, 2 to 3 times cash flow. And I can point to companies trading under 2 times cash flow. I don't think I can do that in any other industry in Canada, talking about how cheap the stocks are. So that's a positive, in terms of downside risk protection. If we get Carney saying that he wants to develop resources, be it mining, forest products, and the energy industry, because he knows he needs more economic development. We need more jobs for Canadians, high-paying jobs, and we also need the ability to have more tax revenue going to the provincial governments. You saw the announcement about the Ontario budget deficit, that the numbers are skyrocketing versus the assumption that they were going to have a balanced budget soon. 14 billion versus a 1 billion number. That's how crazy the numbers are. The federal budget deficit's going to be enormous. So, you need to find revenue sources. Energy is a very good revenue source. It's one of the biggest. It's about 10% of our GDP. It's our biggest export. So, be it natural gas or be it oil or, so we're, on going south, and then LNG going and oil going west to BC and then overseas. So I think in the end, while there's going to be a battle over carbon taxes and emissions, methane emissions, and the industry is doing a very good job on the technology to lower emissions without even government prompting to them. They know this is the way to go, and they live there. So, they don't want a sour gas well next to their home, and then all of a sudden the sour gas escapes and it impacts the safety of their family. So, people don't realize that the industry and the technology that's been developed is because the industry is trying to be good stewards of the environment. They work very, very well with First Nations, and the First Nations are very big supporters. You saw the announcement from Enbridge with the old West Coast transmission pipeline in BC, where the First Nations in the area will own a piece of it. That is what we need to see for good stewardship and also for good sharing of the wealth creation that's being done in Western Canada in the energy business. And I think the examples we're seeing, including that Enbridge one and others that we've seen, are the way the industry will go that has a buy-in from First Nations. First Nations get good revenues and ownership, and they have very good paying jobs for their people, and importantly, training for those skilled jobs provided by the companies who do that, again, because they need skilled workers in the areas where they're operating. Grand Prairie, the northern part of Alberta, Fort McMurray. So having a buy-in from the local communities, Indigenous and others, is important for the industries to continue to be able to grow in the years ahead.
Really good points, and I agree. I think these are elements that are often overlooked by people who are looking at the oil companies. So we'll see how that develops. I always like talking about what's going on in North America, but I wanted to bring up OPEC as well. So we got the news that they're going to speed up their production cuts or production hikes in June. And I'm curious to get your thoughts on that as well, because what is the plan there? What are the goals of OPEC in doing this, and how do you see that playing out?
Yeah, OPEC is announced that they were going to cut production by 400 or increase production by 411,000 barrels in the month of May, another 400,000 in the month of June. And we've seen where many countries don't have enough money to be spent to keep production up, Nigeria, Libya, and others. So there's no new growth coming from them. The only countries that really can increase production are Kuwait and Saudi Arabia. And Saudi Arabia potentially 600,000 barrels. So, what they're giving is new quotas for those 411,000 barrels. Many countries can't use the new quota that they've got. So real barrels coming on the market won't be 411 in 1 month, 411 in another. It might only be 400 for the 2 months because of capacity limitations by many of those countries. And Saudi Arabia is not going to want to push too much down on the price of oil, and because they have a lot of expenses, including spending a lot of more money on things they did with Trump this week, where they're going to be buying a lot of more military hardware and energy infrastructure and doing deals on LNG. So to me, I don't think we're going to see that much oil coming on. And during that same time when that oil is supposed to come on, that's when Venezuela loses the 500,000 barrels a day. So the reality is there's not new oil coming on a net basis. And then if Iran has their, the issue with them, where they get told in Q3, you're now sanctioned, and they lose 1.5 million, 2 million barrels, then the game is on from the bullish side The reason we got bearish in Q1 2024, when we were up at the, we were $87 in, at the end of Q1, was we were beginning to see that, number one, U.S. consumption was coming down year over year, the biggest demand market in the world. And two, China, which was importing, 14 million barrels a day, people were saying, oh, that's great, if final demand is there. But the Chinese put together another strategic petroleum reserve of 50 million barrels, and 1.5 million of that 14 was going into the SPR. Once that SPR was full, China, and that was approximately at the end of Q1, that's when the demand started weakening from China. And that's when we started seeing the price of oil come down from that 87. And it went to, that was in April, late March, early April. It went down to $65 in September. So that's why we were cautious and said, we're going to see weakness. We felt the same way when we got to 79 at the beginning of this year. But now we're at the bottom of the range on price, where the industry is not going to bring on a lot of new production. And two, the summer's coming. People drive more in the summer. The biggest demand is the winter. It softens in the shoulder season of the spring, rises in the summer, weakens in the fall, and then picks up again for winter 25, 26. So we're going to see, 104, 105 million barrels a day of consumption this year. If it goes up by 1 million next year, that just means, stronger demand. And the key thing is, it's not going to be the OECD that has the growth in consumption. The OECD will be flat. U.S. is up, 1.5% over last year. Gasoline demand's only up 0.5%. So it's not really growing very much. You're not seeing much growth, in Europe in terms of, because of EVs and fuel efficiency and everything. The demand is coming from the third world, the non-OECD, from Africa, from South America, from parts of Asia, where they are bringing on the new lithium, the nickel, the copper, all the things we're going to need for that transition to a more fuel efficient, energy efficient world. They need to use more energy to do that. And for the facilities, the mines, the whatever, upgrading of copper and nickel, refining it. And then the people who are doing the work want a higher standard of living. They want electricity in their homes. They want running water in their homes. They want to go from bicycles to cars and trucks and things like that, just like, we've had in terms of economic development here, as we saw what happened in Japan and Korea, over the decades as they, went from, agricultural to industrial economies. So I think that by the end of the decade, while we may see 1 or 2 million barrels fall in the OECD in terms of consumption, and the mix will change from, transportation to things that we use the energy for, chemicals and, all the things we do, my eyeglasses, your computers, your keyboards, there's so many things that have plastics in it that we use around us. So that's going to be what we'll be using. While in Asia and the emerging world, they will be using the raw material, and they will see 6 to 8 million barrels of demand growth. So you have 6 to 8 growth there, -2 in the OECD. That's net growth. The industry is not spending enough money today to keep production flat. So if we want the industry to grow production, that means they need an incentive to do it, an economic incentive, which means rate of return, which means prices have to go up to create that rate of return.
That really nicely ties together some of the topics from the beginning of the conversation. So thank you for going into that. And I want to make sure we get back over to the company. So I think you had mentioned a buy window approaching in June. And I want to ask you, when we're looking toward that, what types of companies would you be honing in on for that time?
Yeah, I think people should have exposure to the different areas of the market. Natural gas and natural gas exports, they're going to do well. The price of natural gas will firm up as LNG Canada comes on, as the other projects come on. So companies that are natural gas focused make sense. You want to be involved in oil, especially because we have a tremendous resource base. We're one of the second or third largest reserves in the world. So we will be able to bring on more production efficiently, environmentally, supportive of the industry. And then you want to be involved in the service sector because the industry needs the drillers and frackers and that. And so then the question is, do you want income? You can look at royalty trusts, or you can buy companies with good dividend yields. Let me give you a few examples. You've got companies, in the industry that are paying some very decent yields, and also provide some good growth. So, for example, Whitecap, which is merged with Veren, is paying a 73-cent dividend. The stock yesterday was $8.52, providing you with an 8.6% dividend yield, and they're growing rapidly in the Montney and the Duvernay with both the natural gas and the liquids-rich nature. They were 65% liquids, 35% natural gas. That natural gas component portion can go up. If you're looking at something in the infrastructure area, you can find companies that are yielding you 5 and 6%. You can go to an Enbridge. Enbridge is yielding 6% right now, so that's a good story for people. You can look at a lot of companies that are a little bit smaller. And Vermilion Energy, 5% yield with operations in Europe, both in Croatia, Germany, and the Netherlands, as well as in Canada, as well as Australia. And on the service sector, you've got some very, very cheap companies. Trican Well Service pays a 4.5% dividend, aggressive NCIB program, normal course issuer bid, where they're buying back their stock. And the company, has minimal debt. And if the fracking business picks up, they have the most modern fleet, DGB, natural gas fired versus using diesel. So they're, from a point of environment, the companies like them. I would throw another company at you, Tourmaline Oil. Tourmaline, of course, has just been involved in that, the Strathcona natural gas sale. The company pays 50 cents a quarter, $2 a share, plus regularly pays extra dividends on top of that. So you're talking about a company, which is a $23 billion market cap. So very, very liquid stock, trading at $63. They were 605,000 BOE a day in Q1, and they talking about growing to 800,000 before the end of the decade. So you got a growth story there run by probably the best management team in Canada. And then there's a lot of value companies out there. You look at a Bonterra Energy, a Kiwetinohk, Obsidian, where you've got great value there in terms of the difference. So one of the measures I look at is the net asset value, the reserve value, and so the reserve value is now the reserve value for the end of 2024, done by GLJ, Sproul, McDaniels. Those are the main operators. So, for example, Birchcliff, which is a natural gas producer, has a $22.54 NAV at the end of last year. The stock traded yesterday at $6.42. So you're paying, 30 cents on the dollar to reserves that other people are buying, like we saw the deal that we just saw with Strathcona. And the Tourmaline, which I talked about, $88 NAV, and the stock trades at 63, so a discount to its NAV. And as prices of natural gas goes up, as their volumes go up, those reserve values go up. So we think, that stock has, potential double between now and the end of the year. Bonterra, 21.44 NAV, stock closed yesterday at 33. You can look at a Kiwetinohk, which is a natural gas producer with a very strong growth profile. They were $37.10 NAV at the end of last year. The stock trades at $16.75. So I've got a list of many, many companies that fit those kind of same profiles where you can buy them at significant discounts to depressed NAVs based on low commodity prices. Because at the end of last year, we were looking at, 60s, high 60s for the value. And if we get to an $80 or $90 value, reserve value 2-3 years from now, those reserves values go up, plus growth in production, growth in investment. They pay down debt. That all adds to the value to the shareholders. And in the meantime, many of these companies are paying you very nice dividends. So you get paid while you're waiting. And I'll just repeat some of those numbers. Enbridge, a 6% yield. Freehold Royalties, which is a royalty company with Canadian U.S. assets, 8.8%. Whitecap, I mentioned, 8.6. You've got 9.9 on a Surge Energy, which is a oil-focused company. You've got a company, Petrus, with a 9% yield. So there's a lot of decent companies out there. So people can go to our website and see, free complimentary copies of our research. And if they own the companies, or they want independent views, what we do is we don't do like the institutions where, they have 30-page reports, and, they analyze G&A per BOE and op cost per BOE, transportation. People on the retail individual side want to know, why should I buy this story? Where could this thing be a year from now? Where could this thing be 5 years from now? At the top of the cycle from the bottom where we are now. And, the management own a lot of shares. We want their money in before ours. Is it a discount to NAV? Is the balance sheet in good shape? So we cover the issues of how they did during the quarter, like Q1 now. We then cover the things we liked about what they're doing. And then we put on another one, on that balance of evidence, issues of concern. If we see insiders selling, if we see debt going up, if we see op costs going up, we mention that. And we say, here's an issue that bothers us, and we'll keep you informed from quarter to quarter. So that independent view for individual investors is important. And that's why we created the product in 2017. And we've had very good growth, lots of support. And we attach that to a conference. So a lot of times people, own stocks and they don't have access to management. So if they own a company and they're bothered by something, coming to our conference in Calgary in October, which will be this year, October 18th at Mount Royal University, they can talk to the CEO of Tourmaline or Surge or any of these companies, Freehold, and they can ask them questions about the company. That FaceTime will give you a comfort zone to own that stock, to hold that stock for the cycle, and of course get good dividend income, but but be comfortable that the management, that you've talked to the management, and that I think is a differentiator from our product versus others that are out there.
Absolutely. Well, I really appreciate all the company examples. I think it illustrates all the choices people have out there. And I'll leave a link in the video description to your services as well as the conference details coming up. So very good to go over all of this. I think we've covered a lot in oil and gas. But before I let you go, any final thoughts that you would want to leave investors with? I know it's a very volatile time, as we've been discussing.
Yeah, what I want people to take away from this discussion on energy, but more importantly, we haven't had a commodity cycle since the 1999 to 08 cycle. And right now, commodities are in short supply, be it copper, be it uranium, be it nickel, be it crude oil, be it natural gas. So, and we know gold's had a beautiful run. Uranium had a beautiful run, backed off. Lithium had its time in the sun. We're going to need a lot of those products between now and the end of the decade. So you want to have in your portfolio, sit down with your investment advisor and decide what resource weighting you want. And I would recommend you want exposure to uranium. You want exposure to, the key metals like copper. Of course, everybody wants gold and, precious metals in their portfolio, and then have a good weighting to energy. The biggest component of the CRB, Commodity Research Bureau Index, is energy. So whenever you make the decision, have some of each. And if you're conservative, own pipeline infrastructure, royalty trusts, or there's a high dividend yielding producers, so you can get a good yield, more than you'd get in the bank, as well as you'd have the growth in the cycle. But the key thing is, I think this commodity cycle could last way into the next decade. And it's important for people to have exposure in their portfolios. So sit down with your investment advisor, decide what's appropriate for you, given your age, risk profile, and comfort zone. But be involved in commodities, because between now and the end of the decade, I think it will be a very strong performer with outsized returns, not 5 to 10%. I think 20, 30% compounded rates of return are possible into the end of the decade. It won't be without volatility, as we know. But if you buy a stock at a bargain level like we had in April, we may have in June, and you hold it for the 5 years of the cycle or longer, then you could have doubles, triples, quadruples. And if people say, wow, that sounds insane, pull up the charts from 2020 and see where the stocks went between March of 2020 and, and mid 2021. There were a lot of 10 baggers. I repeat that, 10 baggers. Go back to 2008, 2009, after the financial crash. What did stocks do from the bottom in 2009 into the next year or two? Again, multiple baggers. That's what we have now, is such cheap prices that when the game gets on, $70, $80 oil for WTI, that's when you're going to see the start of these big wins. And I think people, who've made money in the past in the energy area or any of the other commodities areas, gold has done better for investors this year. They know the torque and the leverage that these things have. Once they get over their break-even price, if gold is $1,100 and your costs are $900, but then all of a sudden you're now, $3,200, $3,300, your costs haven't gone up much. That profitability difference makes for much higher stock prices.
Okay, I think that's a perfect point to wrap up on. I know people tend to choose their favorite commodities and focus on that, but we've got all the commodities that are really going to be moving in the coming years. So really good note to finish on. And thank you so much for coming to go over what you see happening right now.
My pleasure, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Josef Schachter.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.